The difference between making $5,000 a week in the markets and losing trade after trade is a simple trade management strategy. If you want to stop losing and start winning, I break down how right now. My name is Mike, and I teach you how to trade right now. If you want to make money in the markets, stocks, currency pairs, and crypto, you come to the right place. Trade management refers to the strategies and systems traders use before, during, and after an entry. It's risk management with the goal of minimizing losses, maximizing profit, and ensuring consistent trading success. Losing money is never fun. It's a nuisance. So I pursue pest control, position sizing, entry opportunities, stop loss targets, and take profit targets. Let's review each one by one. Position sizing refers to the amount of capital you'll allocate to each trade. It's usually a percentage of your account balance. The higher the risk tolerance, the higher the percentage. The rule of thumb is 2%. If you have $1,000 in your stock brokerage account or cryptocurrency exchange, then you should allocate $20 per trade. Adjust the allocation as you increase in confidence, but as a beginner, your risk percentage should be no higher than 5%. Forex works differently, and it's a tad bit confusing. You can buy one share of Apple at 0.01 Bitcoin, but you can't buy 1 unit of currency. Instead, you buy a lot. Lots come in standard sizes that are universally recognized across all currencies. A standard Forex lot is equal to 100,000 currency units. A mini Forex lot is 1/10 the size of a standard lot, or 10,000 currency units. A micro lot is 1,000 units, and a nano lot is equal to 100 units of a currency pair. Most often, I buy standard lots. If the pound USD exchange rate was 1.2000, one standard lot of the base currency, or pound, would be 120,000 units. This means that at the current price, you would need 120,000 units of the quote currency, or USD, to buy 100,000 units of pound. You're probably asking yourself, how does this relate to position sizing? If we review the position sizing calculator by baby pips and select USD as our account currency, enter our $10,000 account balance, 2% risk reward ratio, set our stop loss to 10 pips, and select the pound USD currency pair, then we'll be given our lot size of 2. This is our position size. A quick word. I selected 10 as my stop loss pips. We're going to review stop losses in greater detail later. For now, set it and forget it. We'll come back to this. With our position size in place, we move to entry. For all markets, I trade break and retest. In the description below, you'll find links to videos detailing breakout as well as break and retest trading strategies. For now, let's head to the charts. This is Apple on the 15-minute frequency. This is a strong trend line because we count 5 wick touches of the downtrend trend line. After a breakout to the upside, a support and resistance zone is established. If you want to learn more about support and resistance zones, check out the video link in the description below. After price breaks down through the support and resistance zone, we see a few wick rejections. Buyers appear to be in control. A few candles later, we see a huge bullish momentum candle, but we don't enter yet. Remember, price will often retest a support and resistance zone, especially after such a huge momentum candle. And that's exactly what Apple did. The 6th candle gets super close to our support and resistance zone before rejecting it to the downside. This wick rejection after our break and retest is a sign that buyers are in control. This becomes our point of entry. Our entry strategy is straightforward. We wait for the break and retest of our support and resistance zone. Once we have our entry figured out, we must include a stop loss and take profit target. Always include both. If our entry is wrong, it minimizes our losses. If our entry is correct, we make money and we keep greed in check. Always set your stop loss target slightly outside of the support and resistance zone. We could be even more cautious and extend our stop loss to below the prior wick rejections, but support and resistance zones are the rule I live by. Oftentimes you'll hear traders advise a 2-to-1 or 3-to-1 risk-reward ratio for all trades. This means that for every $1 you invest, you will either lose $1 or make $3. I don't know about you, but I'm weary of rules that apply to any and all trades. Instead, I look for key support and resistance zones. Where did price reverse in the recent past? I count 3 support and resistance zones where I can set my take profit target. Each stock, cryptocurrency, and currency pair moves differently. For the assets I trade, I see success at the 3rd take profit level. In the instance of Apple, this happens to be the start of the downtrend, which is an added layer of confluence. I plan to sell 100% of my shares at take profit level 3. You could sell 30% of your shares at TP1, 50% at TP2, and the remaining 20% at TP3. Experiment and figure out what works best for you. With pest control in place, I enter the trade. 2 hours later, I exit profitably at a 2.7-to-1 risk-reward ratio, effectively tripling my money in 120 minutes. Not bad. I set a 2% position size, entered after the break and retest of our support and resistance zone, set my stop loss outside of that zone, and my take profit target was the beginning of our downtrend reversal. And I made money. This exact trade management system works for stocks and crypto. It also works for Forex with only a slight change. Let's go back to the charts and I'll explain. Do me a favor, if you're enjoying this video, like and subscribe below. Help me help you. Now, back to our regularly scheduled program. You didn't think I forgot about pips, did you? This is Pound USD on the 15-minute frequency. This is also a downtrend reversal following a ranging market. We could have set our take profit level to the standard 3-to-1 risk reward ratio, but we would have lost out on a lot of money. After price broke out of the range to the upside, price immediately retests the resistance zone and bounces off of it, signaling buyers are in control. This is our entry. I set our stop loss outside of the resistance zone, and the take profit level is a key level. For Apple, we sought the 3rd support and resistance zone on the 15-minute frequency. For Pound USD, I'll look for the 3rd zone on the 4-hour frequency. Remember, we're looking for price reversals. One way to see clearer is to switch from candles to lines in TradingView. You want to mark every direction change, which I do in green. Heading back to the charts, I set my take profit target to the 3rd support and resistance zone, which increased my risk reward ratio from 3-to-1 to 7-to-1. In TradingView, you can right-click your long tool and click Create Limit Order. From here, you'll see your take profit and stop loss targets expressed in price and pips. A pip is a unit of measurement to express the change in value between 2 currencies. If Pound USD moves from 1.1115 to 1.1116, that 0.0001 USD rise in value is equal to 1 pip. We can now head back to our position sizing calculator and adjust our stop loss pips accordingly. With the adjustment in our position size, we enter the trade with our take profit and stop loss targets in place. Less than 4 hours later, we exit the trade profitably, risking $7 to make $1 or a 7-to-1 risk reward ratio. Perhaps the best thing you can do when it comes to trade management is keep records. It can be as simple as a spreadsheet. Trade journals are an excellent way to track each trade, outcomes, and the lessons learned. You'll start to notice patterns and refine the position sizes, entries, stop losses, and take profit targets that perform best for you. If you found this information helpful, all I ask is that you like this video and subscribe to the channel below. It takes 2 seconds and 2 clicks, and it means so much to me. Remember to check out my other videos, and thanks for watching.